I have a lot of clients that come to me and say, Hector, my banker, my bank, it's asking me for financial statements. It's asking me for reports. I'm applying for a loan. Can you help me? They typically really rely on us to provide these things, and my clients have been properly coached that if they're going to apply for a loan, not to print random financial statements from the QuickBooks, because first of all, they could be messy. We don't know if things are reconciled. How about things classified in the wrong place? You could totally throw off your banker by not having that. So I believe there's a lot of value on having the clients involve us, the consultants, in these type of things. So I'm going to ask you a quick polling question to just kind of have an idea of whether or not you do perform these services for your clients. So do you have clients that ask you, hey, can you help me get some financial statements for my bank, and are you involved with that? And it will be interesting to know whether you don't want to at all, or it will be something that you do want to get involved with, or you already get involved with. Okay. Now, what happens is a little bit of a disclaimer here. What happens is if you're a CPA and your client asks you to prepare financial statements, you may have to get into a whole engagement, right? You have to first of all get paid for your work, for your time. You may have to perform a quick review of the financial statements. You may have to apply certain special accounting rules. You may have to disclaim certain items. So it's not it's not that simple if you're a CPA to just jump in and produce those financial statements. Okay, so I'm going to share the results with you real quick to see kind of what the answers were. And there it is. Okay, so let's start with what do banks typically ask for, and go through the reasons why. So typically banks ask for 2 to 3 years of tax returns. They typically ask for personal and business, even though it's a business loan. And the reason for that is because they know that the small business owners have a lot of control over the business itself. So they like to see if there's potential issues with income or with losses on the personal side, to make sure that the corporation stuff that can potentially affect the personal and vice versa. And then they ask for interim financial statements. So they always ask for the QuickBooks financial statements in the middle of the year. And we're gonna focus on that. So we're gonna take you through a whole flight of that. I used to be a banker, and I used to request these things for a living. I really didn't understand why until a couple of years in, where I really started understanding how the banks think, how underwriters think, what are some of the information from these reports that are useful to the banks, what is not. So I'm gonna take you to that entire flight. So the optional reports, typically banks don't ask. Well, it depends, but not always they ask for AR aging, AP aging. Not always they ask for inventory valuation, cash flows, budgets. But if they're well presented, I recommend you add them, because everything that you add to those financial statements helps out. Okay, let's go to the next slide here. And so what do typical accountants or bookkeepers do when the client says, hey, help me send my bank some financial statements? So they'll go into QuickBooks, they'll print the P&L, print the balance sheet, PDF it, email it. It takes them less than 5 minutes. The typical accountant or bookkeeper is involved in that request, but it's not really there to kind of help your client. So what a skilled business consultant would do, and again, I have to make the CPA disclaimer, it would apply something that I call the art of preparing attractive reports, which is what I'm going to cover in the next 10, 15 minutes or so. And it does take a couple of hours to do right, and it's always billable. Again, your client is always going to pay an accountant or consultant that is helping them get access to that capital. If they're asking for a loan, if they're requesting a loan, it's because they have an opportunity to grow their business, and getting, increasing their chances. You can't guarantee it, but increasing the chances of getting approved with attractive financial reports is definitely a huge, huch value. So I made the CPA disclaimer. Some of the techniques that I'm going to show you, they could use GAAP concepts, but for the most part, because we're sort of modifying the presentation, this may hinder your independence. So if you're engaged with a client to do audits, reviews, anything with attestation, you would lose it by getting involved with the client and doing the things that I'm about to walk you through. So first of all, let's talk about the choices that we have to make. So the bank will ask for a P&L and a balance sheet. That sounds like a simple request. But we have to make a choice. Are we going to send them collapse, expanded, or are we going to select what we're going to collapse? Are we going to send month by month? Are we going to send quarter by quarter? You know, is there any value to doing it by class or by job? Last month with a year-to-date previews. So I kind of want to cover those real quick. I'm going to jump into QuickBooks Desktop here. Give me 1 second so I can show you that example. And it should be up and running now. There it is. Okay. So when they ask for a profit and loss, right? So typically we would take in a profit and loss for the middle of the period, year to date. It's very common. I would say one of the most common things is that we actually stop at the previous month. That's one of the single most common things is we send year to dates, but they're not really year to dates. They stop up to the previous month because the last day of the previous month typically is the last day that it's been reconciled. The other choice we have is, do we send it expanded, right, where it shows all the sub-accounts, or do we send it collapsed? And my take on that is I would only show it expanded if the breakdown adds value to the presentation. If it adds fuzziness or if it makes the report bigger than 1 page, I typically would recommend not to do it expanded. The other questions is, should we send monthly, right? So should we do something like this and send a monthly report? So my take on this is, since the bank is not asking for a monthly, if you have a very stable revenue stream, right, where every month, like in this case, it looks like it's stable, for the most part it's stable, but every month is stable, then month by month works because banks like stable income. If it's all over the place, like 1 month is 100,000, the other month is 20,000, or like in this particular case, let me make this a little bit bigger. In this particular case, we're going from 84,000 down to 65, up to 114 down to 60,000. In this particular case, I would be careful with showing a quarterly report. Again, the premise is we're not changing the numbers, we're changing the presentation. I want to make sure that's very clear here because we're still independent accountants doing an independent accountant's job. But what I'm saying is, if the quarterly report or the monthly report helps the deal, right, because it shows growth or stability, then you show it. If it shows instability, high seasonality, all of income and expenses all over the place, then I would probably avoid doing that. The other common technique that we do is show a year to date, and then right next to it, show a previous year, right? So what I would normally say, like in this particular case, there isn't anything on this QuickBooks file, but if the previous year shows in comparative to this year, an increase in sales, a decrease in expenses, an increase in margin, then show it comparative. If it doesn't, don't show it comparative. Don't add any more reasons for the bank to look for a decline. So there's a couple of tips I wanted to show you on that real quick. Okay, so back to the PowerPoint, and I'm going to turn off the webcam here because we're getting some speed issues. Back to the PowerPoint. So let's talk about the organization of the report, right? Cost of goods sold, expenses, other income and expenses, account numbers, sorting by value, and marketing and selling versus general and administrative. So let me show you a slide that I put together on this. And the slides are available for download, so I recommend you have these. These are very useful to work with your client with. Is cost of goods sold, you want to reserve direct expenses, typically variable, so things that change as income changes. Expenses you can associate with a customer or a job, and they're typically predictable. They're predictable because gross profit is a fixed percentage. So when you have a lot of sales, your gross profit margin stays, but your gross profit amount grows and shrinks with it. Now, the operating expense are used to calculate net profit. They're typically indirect. I say typically fixed. So, for example, telephone expense is considered to be a fixed expense. But a lot of people say, well, one month my cell phone bill is 200, the other month is 300. That's not fixed. Well, yeah, it may not be the same exact amount, but from accounting perspective, that's a fixed expense. It's typically fixed. Typically, they're unallocated. There isn't anything. You should not have any expenses allocated to jobs. If you have anything allocated to a job, it should be a cost of goods sold. And it's semi-predictable. The reason why the fixed operating expenses aspect of it are not as predictable is because there's a lot of management discretion. There's management judgment, right? The management decides whether you should have a 3,000 square foot office or a 500 square foot office. Management decides if you're going to have, you know, top of the line computers or no, or simple, cheap, inexpensive computers. So that's what I mean by manager's discretion. And then make sure that you move everything out of expenses and income that is extraordinary, that is non-operation. This is one of the biggest mistakes people make. They put interest income in the top revenue part. They put interest expense in the middle of the operating expenses. Depreciation, amortization, income tax, capital gains and losses, extraordinary items. Separate them from your fixed expenses because they really provide a lot of value when you're displaying the reports. Okay. The other quick piece here, I know most of you know this, is the account numbering system. You know, make sure you follow an account numbering system that a lot of people will understand. One of the big areas where people get a little bit confused is, you know, whether we should have two numbers for expenses. And my answer is yes. If you can separate general and administrative as one bulk of expenses and selling and marketing as another bulk of expenses, I would separate them into 6,000 and 7,000 accounts. And I'm going to show you a specific example with that and show you how great it is to do something like this. So how would you split general, administrative, and sales and marketing? So typically, operating expenses like rent, payroll, overhead, staff that is not directly related to sales, that would be under G&A. These are the most typically fixed, right? These are fixed expenses, and they're very typically indirect. And these are predictable based on budgets, right? Because you know, we set up budgets for G&A expenses. Now, for selling and marketing, these are advertising. These are incentives to sale, bonuses, anything that could be directly associated with selling, right? Not with the sale, but with the act of selling. So if it's directly associated with the sale or the customer, that's cost of goods sold. But if it's related to selling activity, then it would be under this category here. Your sales payroll will be here, your sales staff payroll, and this is typically variable. This would actually have a more direct relationship with, not with sales, but with the growth of sales. So typically, an increase in selling and marketing expense should render an increase in sales, right? It doesn't go the other way, where an increase in sales directly creates cost of goods sold. This is different. This would be more of a cost effect, right? So if I invest into this area, I should see sales in the future. And these are harder to predict because obviously the manager has more discretionary use. Onto the balance sheet, some of the things that are very important to keep separate is, you know, spend good time identifying fixed assets. I can't stress that enough. So many people put fixed assets under expenses, office supplies, and they put it on the profit and loss. And what ends up happening, the big issue is, what ends up happening is that you expense everything and you have no way to present the tools that your business has available to produce. That's one of a huge problem, right? So the tools are available for you to produce, to make money, your infrastructure, that should be in your fixed asset report. So what's the typical threshold that we use? The most typical that I've seen is 500. Obviously, it has to get depreciated, and typically the tax guy takes care of that. Now, under other assets, people get a little bit confused about what goes in there. Other assets is going to be for franchise fee, for goodwill, security deposits that you're going to get back in less than a year. So typically, if you have a security deposit that's only for a year, which is not common, right? Because you try not to rent for a year, but the rent contract is a year, but you want to stay there for longer. So because of that, we put that in security deposits, long-term receivables, investments, things like that. Now, under current assets, the concept is anything that is cash or convertible to cash within an operating cycle, which is typically a year, that would be considered a current asset. And I have them organized in terms of liquidity, and liquidity is a big deal for banks and for lenders. Liquidity means, you know, how, if I go after the assets of this business, how quickly can I get repaid? You know, through, for example, you know, cash, obviously that's quick. Financial investments, you know, that's like securities and investment in the stock market. Receivables, inventory. So basically, the closer you are to the top, the easier it is for the bank to recover if your assets are being collateralized. Now, current liabilities, same sort of concept. If it's a claim against your cash and is payable within an operating cycle, which is typically a year, things like credit card, lines of credit, make sure you don't put lines of credit under long-term liabilities. Put lines of credit under current liabilities. Loans payable within 1 year. So for long-term, you know, anything that's payable. Oops, there's a mistake on that one. But this is just basically payable after a year. So payable after 1 year, right? Sorry about that. And then under equity, one thing that I strongly recommend, especially with partnerships and with retained earnings, at the end of each year, grab that tax return and roll over your retained earnings to each of the partners' capital accounts. That really helps the presentation know, you know, where your capital is, which of the owners has claim into that. And the single most important tip I can give you is when the shareholder lends money to the business and you put it under liabilities versus putting it on additional paid-in capital, it creates a problem with your net worth, right? Because if the owner puts money in the business and does not have a loan attached to it or a loan contract, loan terms attached to it, there should be no reason why that capital is going to be under a liability or long-term, short-term. So it really helps with presentation having the shareholder loans as additional paid-in capital instead of that. Okay, AP/AR reports. So one of the most important thing I'll tell you about AP/AR reports, and want to give you some context in terms of if a bank looks at something like this, why would they do this, right? To kind of show you. So if a bank asks you for a receivables report, you have to understand what they're going to look at. So these are the things they're going to look at. One, who are your customers, right? Now, you know, are your customers reputable, established businesses, right? Is there a high probability that you will get paid from these customers, or are these companies that are known to be in bankruptcy or something like that? Whoops, I keep opening a QuickBooks file. Let me open a sample file. What else are they going to look at? They're going to look at aging, right? If you have a lot of receivables that are, in this case, if you have a lot of receivables that are under 90-day plus or the 60-day plus, the probability of collection goes much smaller. It's like when your cousin, you know, asks you to borrow $100 and you give it to them, and then they ignore you for a whole year, thinking that the longer it takes, the closer the probability is that you'll forget that they owe you the money and you're going to collect. It's sort of the same concept, right? So the older the receivables are, the less of the probability of collection. The problem with that is when banks see that you have a lot of receivables, which normally from a faraway view looks like a positive thing because it's an increase in assets, it may be very negative if the bank has reason to believe that these receivables are not collectible. So what you want to make sure, and let me go back and take a look at this. So you want to make sure when you're displaying financial statements, this account receivable aging reports, you want to make sure that the due date on these invoices are correct. So one very typical mistake that people make is that there's an invoice in QuickBooks and the due date is hidden or it's not even shown, and they have the wrong due date. So what ends up happening is if the due date in this case is correct, so let's say this is 10/30/2018, right? And today is December 15th. If that due date is correct, then it's going to move along in the AR report. So what used to be in a current status is now 31 to 60-day status. Same concept with old invoices. It is possible that, and I'll show you an example. So it is possible that I have an old invoice, let's say from 6 months ago, right? I have an old invoice from 6 months ago, and I'm going to put here due on receipt, and I'm going to pull up my AR aging report, and we're going to see exactly what that looks like. So I have an invoice from 6 months ago. It looks like it's 90-day plus. Now, what if this is not 90-day plus? What if the terms was, yes, we did the work 6 months ago, but our agreement is that you were going to pay 4 months later? Well, that changes the dynamic of everything. Aging is not about the specific age of the invoice, is the age of the due date. It is so important to keep that in mind. Aging is the age of the due date. So if your terms said that this invoice was due November 30th, even though it's from back in June, if this were my original terms, this is part of the contract, whatever the circumstance may be, when I go back and look at my AR18 report, it doesn't look 90-day plus anymore. It looks correctly where it's supposed to be. The other thing that banks look in an AR report is they look for something called receivables concentration, which it means when a great part of your receivables is held by 1, 2, or 3 companies, or even less, so 1 or 2 companies, it means that you, as a business, may be at the mercy of the financial health of the other business. Because if your client goes out of business, there goes 90% of your receivables, 80% of your receivables. So it's something important to keep in mind to make sure that you know the bank is going to look at that, right? If it's a reality, it's the reality. Now, for inventory valuation, one thing I'll tell you, one of the most important tips is write off inventory constantly, regularly. You would think that having a lot of inventory helps. It actually does not, because there's something called inventory turnover, which is the measure of how long it takes for you to get rid of your inventory. The banks look at that. They want to know that you sell good inventory. They want to make sure you don't have obsolete inventory, right? If you're a technology company and you have a lot of inventory and you show the bank a inventory valuation report, and you have a bunch of iPhone 4s, you have $100,000 worth of iPhone 4s, the bank says, you know what, this is worth nothing, right? Because nobody buys an iPhone 4 anymore, right? It's kind of the concept. So there's important concepts about that. So constantly write off your inventory. Okay, so for my last piece, I'd like to talk about my experiences in the bank. Okay, insider advice from a banker. I'm not much of an insider anymore, but so basically I wrote this article where I basically put together everything that I learned in the bank about why is it so difficult to get loans approved. I used to be a lender. I used to be a small business lender. My job was to put together deals, try to get them approved for small businesses. So I went through the process of understanding every little thing that the bank looks for: solvency, liquidity, equity. So I recommend you look into that article. It's actually it's very dear to me. It did take me some time to write it. So based on some of the things I put in that article, my experiences is with the bank. The banker typically wants you to get the loan. The banker encourages you to apply for a loan. The banker will make money or makes commission. That's his job. The banker feels optimist, right? They go to your client and says, yeah, sure, you get the loan. But what's the problem? When it gets to the underwriter, that's your bottleneck. Underwriters need to document and make a judgment on why it made sense to write that loan, right? They have to document the risk level of the loan, right? The probabilities of losing on that loan or defaulting on that loan. If a lot of loans go bad, underwriters lose their job. So I call underwriters the pessimists and the bankers the optimists. So I want to take you through an exercise of just some examples of things that I went through when I was in the bank presenting financial statements for my clients for loans. And me as a banker, I was an optimist, right? So scenario number one, I have a client that had really fast growing sales and they were asking for an expansion loan. So the business owner and the banker were excited, right? Because we're expanding. What does the underwriter say? Well, they're growing too fast. They may lose control of quality. They may lose capacity to deliver. So what is interesting about when you look at financial statements and when you present them, I want you to keep in mind that what you see as a positive thing, the underwriter has a way of twisting it to see it as a negative thing. So it is your job to coach your client and to understand, how to explain these gaps of perception, right? The great things about, expanding sales and the negative part of expanding sales. So the optimal that I've seen, the most of the loans that got approved in terms of sales growth is when the sales were slow and steady, right? So 5%, 10%. So 20, 30, 40% growth, it's a great thing, but it could also be seen as a risk. Gross profits are increasing. So as a banker, as a business owner, I would be great. These people have found a way to make more money per item. They're more efficient, right? They're more profitable per product. But the underwriter will come back and say, you know what? Maybe they're buying from a lower quality vendor. Maybe the reason they're saving money is because they're buying a cheaper product. Could this hurt their reputation? So, so what is the optimal thing? The optimal thing is that the margins are steady and predictable. Banks like predictability. And also, you want to explain increase in margins, not due to buying cheaper products, selling low quality product. You want to say, look, we have a revenue mix that involves more high margin products and more services, which are 100% margin. So you want to discuss these things with your client to make sure they know how to explain them to the underwriter or to the banker when they apply for a loan. Another typical one is payroll. Payroll expenses are decreasing. So, glass half full. We are cutting costs. We're more efficient. What does the underwriter come back and say? Well, maybe they have less capacity to serve their clients. Are they firing their high-skilled employees and hiring low-skilled employees? Can the business owner maybe can't even afford to pay themselves anymore. So that's the glass half empty view of decreasing payroll expenses. So what is the optimal things I observe? I observe a steady workforce, low turnover. Something that my underwriter used to look at, and it was kind of a strange thing. My underwriter was very specific. They said, can you ask the business owner what is the average employment age of their employees? And they used to compare if the average employment age was close to the length of the business, because in her experience, a business that has all the original employees or 90% of the original employees is more likely to succeed than one that is turning and churning employees all the time. They're interesting ways to look at this glass half empty, glass half full thing. Now, what about the other side of the coin? Payroll expenses are increasing. So a business owner, a banker, an optimist would say, that's great, we're expanding our workforce. So what would the underwriter say is, well, maybe you're losing operating efficiency. It requires more people to do the same amount of work. Do you have enough managers to maintain high quality? Or is the business owner doing less work and putting themselves out of payroll? Or is the business owner paying themselves too much payroll? So what are some of the optimal things that you want to keep in mind is what they want to see is they want to see a percentage of increase in staff to be with the same growth rate as the sales. And you also want to show that key employees are getting raises and promotions. Key employees, the ones that make the business work. So those are some good ways to mitigate these type of questions, these type of things. Now, increasing shareholder distributions. So so a business owner would say, this is great. Now my business can afford to reward me. And then underwriter would say, they're bleeding the company out of capital, right? And they want the bank to finance their lifestyle. So the optimal thing is to have a strong capital retention policy. Capital retention means not distributing your capital is tightly associated in the financial world with growth. Okay, let's see. Receivables increasing. So normally we would say, that's great, we're growing our sales. And this is where underwriter would say, are the receivables old? Is there a high concentration? Inventory increasing, great. We're prepared for the busy season. We have immediate inventory. Underwriter would say things like, hey, if the inventory loses value, is there obsolescence? So these are some of the important thing is you have to know how the banks think before you put the loan together and sit down with your client and discuss all these possible positive or negative things. And the last thing I'll show you is one of the things that stuck by me. I remember this. We memorized these. A bank used to call it the 5 C's of credit. So the bank says we narrow down all credit decisions to the 5 C's. It's capacity. Can the borrower repay the loan? This is where financial statements come into play, right? Do they have profits? Do they have net income? Capital. Is the borrower invested? Are they putting a down payment? Are they putting capital in the business, or are they distributing it all? That's an important piece. Collateral, are there fixed assets? Are there receivables, good ones? Is there inventory, good ones? Is there collateral that the bank can say, you know what? If the business can't pay, I have something to go after. Conditions, right? Is the industry in good shape? Are there external factors, regulatory factors, environmental factors? So this is where the industry, some banks don't like certain industries. And character. Character is the credit history of the owner, credit history of the business. This is statistical risk. Based on their credit score, they figure out the risk level, and that's how they price their loans. Most banks, the reality is that most banks could approve most loans. The problem is that a lot of banks don't want to charge 15, 20, 30% for loans because they don't want that reputation. So because banks, traditional banks, are in the business of low-rate loans, they typically don't want to write to high risk.